I'm Michael Fox, and this is the Prospector Podcast. And I have joining me returning guest, Mike McGlone, Chief Commodity Strategist from Bloomberg Intelligence. Welcome back, Michael.
Thank you, Michael. It's good to be back. I always enjoy talking to you.
I do enjoy talking to you as well because you're a very pragmatic guest. You know, things are what they are. There's no rose-colored glasses. There's no doom and gloom unless there's reason to have the rose-colored glasses or to be prepared for doom and gloom. So, as I say, it's always a good opportunity to chat with you. And today, I wanted to have you on very specifically. There's the old adage out there that the cure for high prices is high prices. And we have a number of strange situations happening in the commodities that are leaving some of them with high prices and a lot higher for a lot longer than at least I would expect them to be, and maybe you as well. But that's why we're here and talking about it. And I wanted to start the conversation off with the silver market. Silver's been on a pretty good tear as of late. It's been up and over $39, retreated a bit. It's back over that $39 as we speak again. And it's an odd commodity because it's part industrial and it's part precious metals. And generally, the precious metals enthusiast is what drives the silver price. But, at some point, the price can't get too high before the industrial people start to press back on it. And that's where you get these discussions upon the grand silver conspiracy that, they won't let the silver price go. So where are we in that cycle right now, Mike?
Silver's a bull market, but most notably in the back of number one, gold. Gold is obviously a significant beta amongst the precious metals. The significant, I like to point out, there's only four precious metals: gold, silver, platinum, palladium, that really matter. And some of their competitors, there's cryptocurrencies, Bitcoin, there's 21 million of those or 20 million of those. So I look at silver, as you nailed it. I think 40 is for now pretty good resistance. I don't see it getting much below 35. It's just a matter of time to migrates above 40 and gets to 50. The bottom line, though, is it's this most of silver's rally is on the back of gold. You look at it on a 1-year basis, it's up about the same as gold. That's not good. I mean, silver basically is devil's metal for a reason. It trades 2 times the volatility. It should be up double the price of gold. So will it catch up? The bottom line is for silver to catch up to gold and we have a sustained bull market, typically means demand pull forces on a global basis. Usually means industrial demand from China. Obviously, most of that's coming from solar now. Usually means a stock market advancing, and it typically means China doing very well. And that's kind of the oxymoron right now. I look at silver as just catching up to gold. That gold-silver ratio was way too expensive above 100, but typically when it gets that high, it usually has implications for global economic weakness. So that silver gold ratio, when it reached that high this year in it was about April, around 105. Right now it's about 87 ounces of silver per 1 ounce of gold. That was a sign that there's some major financial stress globally. And typically when you get those kind of spikes, you get recessions. Like one of the most significant big ones was in 2008. It got to high about where it is now, around 85. And then the highest ever was in 2020, it got to 124. So I'm concerned. It's elevated. It's part of the reason I think it's gold got expensive versus all the precious metals, and they're all catching up. Silver is the most elastic of those. The key thing is when you say, so I think the way I look at silver now is really good support around 35, going to 40, eventually get above there, but it needs gold to go up, and I fully expect gold is just a matter of time to get 4,000. The key thing when you say the cure for high prices is high prices. That's really resonates most notably in the most elastic commodities, and that's the grains. Particularly, a lot of Canadians can relate to that with canola and corn and soy. You can bring it out in a year, and you can plant more. You can use fertilizer. You can switch crops. But if prices are high and you can think you can make profit, you bring that on, and that's really what happened with Russia's invasion of Ukraine. So, and what's next in terms of elasticity of crude oil is crude oil, and that's why I mentioned those key commodities are still in pretty pretty significant downward trajectories. Now they're getting to low prices. They're getting to that low price cure, but that high price cure is still pushing them lower, and it hasn't really reached the low price cure levels. The difference is gold is the #1 commodity that doesn't face that high price cure as much as, let's say, corn, one of the most elastic commodities, and right next to gold is silver. So I think we're still good there. The big difference is central banks are buying gold at essentially double the pace they've done at the last 3 years. They bought about 1,000 tons a year. This year, they're buying a little bit less than that, but they are buying it about double the pace of the last decade. So they're not buying silver. They're buying gold. Silver's catching up. And for people who expect silver to really blast off, you need some kind of significant demand pull force, and I don't see that happening yet. So I'm kind of concerned. I'm actually kind of getting really more concerned about copper going down and potentially making a bear flag, and gold's bull flag, and silver stuck right in between that.
You see, it's interesting you to say that, because I'm as an investor, like, I always look at the gold price. Gold price is high, but generally the sign of when the gold bull ends is the silver really takes off. It takes off like it's been shot out of a cannon, and it's too early in my mind in this current gold bull run for silver to be running in that fashion. But at the same time, we look at the gold price, we look at the gold silver ratio, which, yeah, I know it really doesn't mean anything except that people believe that it means something. If we went to the historic gold silver ratio, silver, should be heading towards 75, $80, yet its high points has been a couple of times that it's hit just over $50. And in both of those instances, it was like it touched the third rail, and the electronic shock threw it back across the room, and it dove back. So I guess the question I have, as it approaches that $50 mark again, eventually, is that still going to be a third rail, or is it possible that silver could actually move forward and beyond that $50 mark, or will
Well,
the industrials push it back?
I'm more worried about the latter at the moment. So silver is becoming more industrial every day. It's actually, demand now is much more industrial than it was in the past. It's over 50%, versus gold is becoming much more money every day. It's just, central banks are accumulating, partly with what's happening with geopolitics and things. I think it's a matter of time that silver does get to 50, but silver will, as you know, I used to have here, it's the devil's metal for a reason. It'll make it as difficult as possible. The thing I want people to remember is what's changed in the world, and that is, it is much more like copper, much more highly correlated to the stock market. Gold has zero correlation, actually negative correlation sometimes, to the stock market. To me, that's what's happening. That's the key driver. So when you mention any type of industrial metal, silver's in the back of what's lean over to China. 10-year note yield in China that showing deflationary forces at 1.77. In the U.S., it's at 4.25, and the U.S. stock market is still in a pretty significant inflation. So what we see there is silver and virtually all the commodities are stuck between inflation in the U.S. and the back of rapidly advancing risk assets, and deflation in China on the back of what you see in their declining bond yields. So I can't, there's not too much more I can say about silver, except it'll go up as long as gold keeps going up. And for silver to go up with gold going down, I'd say good luck with that one. I think it's that kind of environment right now. That would be awesome if that happens, because somehow we had some kind of major breakout in the global economy. We haven't had an upward revised GDP estimate for a couple of years now. All the estimates are heading lower. The world's facing tariffs from the U.S., and they're just getting started. This is a paradigm shift with this president. He's only been in the office for barely 8 months. So let's think how this is going to work out the next couple of years from now. So I stick with still my bullish bias in gold. I think the silver gold ratio got really high. I don't know how much below 80 it's going to get, but I think the risks are it goes back towards 100, and gold keeps outperforming.
Okay, let's move on to the other precious / industrial metals that there are, the platinum and the palladium markets. again, we're seeing a situation that isn't what, I would think would be normal. Most of my life, platinum and palladium have been priced much higher than the gold prices, and that's not the case right now. But again, they're a metal that's used predominantly in catalytic converters for automobiles, and there's lots of industrial headwinds there. It seems suspicious that their prices are higher to begin with, and at what point in time does the industrial pushback happen? And my understanding is in China, there's not a whole lot of internal combustion engine cars that are being built. It's all electric. Those don't need platinum, palladium. So again, Mike, what gives?
Well, you nailed it. So that's part of the reason silver is outperforming, at least in the bigger picture. This is a paradigm shift. I mean, my electric car is 11 years old, and just the things you get out of China right now, it's that the fact that U.S. has to have 100% tariffs on this vehicle just shows how awesome the technology is. And pure electric cars obviously use a lot more silver, a lot more copper, and don't use any platinum and palladium. Now the hybrids do. So to me, they're getting somewhat technology out. Obviously, there's fuel cells that are good for platinums. First, I'll start with the bear case for palladium. I was quite bullish palladium for a while, but it just basically it reached that high price cure above 3,000 in 2022, and this bear market might last a while. Maybe it gets to 1,500, but it's stuck around 1,000. I don't see a lot for for palladium. Now, platinum has broken out. 1,500 is really good resistance, good responsive supports around 1,200. But the significance is at the end of last year, the platinum to gold ratio was the lowest ever. I mean, it was early in 2025. It got to 0.27. Now it's 0.39. Its average historically is around 1-to-1 versus gold, as we know this. It was just way too damn cheap. And people are actually now saying, no, some gold jewelry is too expensive. I'll buy platinum jewelry. Now, we've heard that out of China. But overall, it was just too cheap. I think it's a matter of time. I don't know if it gets back to 1-to-1, but it was just too cheap. So that's a good factor for platinum. And any type of gold keep going up, I think that's going to really help platinum continue. Palladium, I don't know. I don't have much to go for there. I just remember riding and trading these years ago, and once palladium got to that high level, you just start getting out of all your palladium, and you be a responsive buyer and platinum on dips. And it's in the bull market. It should continue. How far it goes, but remember, it's not the new tech. It's remember this paradigm shift in what's happening in technology. It's all shifting to more demand for copper and silver and not catalysts. So, and that's the main form is catalysts. So for jewelry, sure, but that's why I think silver has more upside. The thing is for platinum, it's just catching up. The good news is it's just, jewelry is way too cheap versus gold.
Okay. Now, I agree with what you're saying. However, there's starting to get to be pushback on electric vehicles in North America and in the West because, you're seeing these high tariffs on the Chinese vehicles. You're seeing Western auto manufacturers kind of pulling back on making electric vehicles, partly because they can't get a lot of the materials that they need for the electric vehicles. The US government is just taking away a lot of the incentives for consumers to buy the electric vehicles. Is platinum and the palladium markets, are they sniffing out that maybe,
Yeah.
these electric mandates in the West are going to be kind of rolled back, and instead of being pure electric vehicles, they're going to be hybrids, which actually use more platinum and palladium than a regular car does? Is that why we're seeing the
I think
prices kind of maintain?
I think that's a couple years trend, but if you look at a couple decades, it's clearly going electric. My electric is a plug-in hybrid. It's a Chevy Volt. It's a great vehicle, and it does have more platinum, as you pointed out. But it's just a matter of time that everything goes electric. It's just a better technology. The energy density of batteries is a complete bull market. And having driven one, the maintenance, the costs, everything are just collapsing for electric vehicles, and internal combustions are basically flatlined. It's just a better way to go. The technology is only going to improve. Just the way it is. Yeah, sure, this is a blip in the road, but just the fact that the incremental buying of all vehicles in the planet, most notably are China and Asia, and that the fact they can get an electric vehicle now at a cheaper cost than most internal combustion engines, and the maintenance is a fraction, and they can go forever. I mean, I just had that problem. All you need is tires and brakes, and they're usually fine. And people who, sure, when it gets bitterly cold in Canada, it can be a problem, but those are just a matter of times we work through that technology. Remember problems we used to have with diesel when it got too cold and the fuel got sluggish, and you had to put things in there. I mean, just having to do that with my fuel tank and diesel. So it's a matter of time, but shorter term, sure. The U.S. is pushback. Mr. Trump's pushback is fine, but the technology is overwhelming. It's just a matter of time. It's just like I put solar panels on my house almost 11 years ago, and the technology's just, it's not stopping, and it's just being stalled at the moment. And just, I like to say, if you look at most of, like, I have colleagues in Mexico City or colleagues in London and other countries and who don't really worry about domestic production. They're just letting those BYDs come in and other Chinese manufacturers, and electrics are great.
So the elevated price might be just a short-term blip in the market, is what you're implying, just because of some of the political ramblings of the U.S. government and so on. So let's move on again to a more industrial metal. Let's talk about Dr. Copper. As you know, he's got a PhD in economics. There's all sorts of things going on in the world. There's tariffs. In fact, copper itself was threatened with a tariff. That was our last discussion point. It turned out the tariff wasn't as bad as what we were led to believe prior to that discussion. You've got China heading into deflationary issues, yet the copper price still remains relatively higher than where it should be when you have these kinds of economic headwinds happening. So, is there a high price cure to copper, or has that high price moved higher than what we would traditionally expect it to be?
So it's re-engaged with copper that trades in London. The equivalent price, U.S. copper as we speak, is $4.46 a pound. The equivalent per pound in London is around $4.25. And I'm afraid that, to me, copper right now has been a short-term indication that might turn out very akin to what crude oil did in 2008. So that pump we did to new high this year got to near 6. It started the year around 4. Right now it's pushing back and forth. To me, the biggest risk for copper is it continues to trade lower, following deflationary forces in China, following the rest of the world is facing tariffs from the world's largest goods importer, a paradigm shift, and ends up down in the year like crude oil did in 2008. That is a big issue I'm worried about. So the first signal, so you look at the trend versus trade. So yes, obviously it made a new high this year. The record high right now as we speak, if we close here, it's at the highest close ever. I think that was 2021 on an annual basis. Can it end the year up, at a record close? And to me, the risks are tilts lower. So I'm putting a short-term trade on it right now. If copper can, by the end of the year, certainly soon, it's got to negate this potential bear flag from that spike up to the high in July. Now we are, we collapsed in August. The key thing, remember what happened, it dropped 20% through nothing in one day. I mean, ran through stops. Those of us who are ex-traders and a lot of our listeners who've traded know how horrible that is when you have a stop and you just run through it. That's a sign of a complete rejection. So right now I look at it as it needs to prove strength now. It needs to stay above basically about $4.60 a pound to prove it's worthy. Otherwise, I see copper as a bear flag, ripe to head lower and taking the rest of the global economy with it. Just basically what's happening in China. If you put copper and overlay with bond yields in China, they used to track very closely, and we had a distortion this year. So I'm very worried about that. And what I'm also worried about is, so that's kind of a weekly chart or a daily chart in copper. It's a bear flag, as we say in technical analysis, but it's the exact opposite in gold. Gold for 5 months now since April is a complete bull flag. It's building the base around 3,300. So gold going up, copper going down. We all know that's a real bad sign. It's a sign of global economic crisis. And there's one thing I think, Michael, that can tilt that to continue, gold going higher, copper going lower, is if U.S. stock market just backs up a little bit. Now, right now we're in summer doldrums. The VIX volatility index just reached the low for the year, right around 14. As we speak, it's around 15. The average for the year is 20. And I mention that because we're heading now towards the volatile time of year. The U.S. stock market has to go up the way I see it now. It's up 10%. And by the way, on the year, so is the stock copper up 10%. I think they're potentially the same trade. And if they start ticking lower, that's a trade that might last akin to what 2008 did, meaning it just started signaling. It may, in this case, but from much higher levels. So that's what I'm concerned about. Prove me wrong. Please, copper, prove me wrong. Dr. Copper shows strength. But if they both start, sticking down the U.S. stock market, like I said, S&P up 10%, copper up 10%. If they end up the year and just start ticking down 5% and stay down, that's dominoes tumbling for global deflation. And why do I say that? We're way overdue for that. It's happening in China significantly. To give that and put that in context, China's right now money supply is running around $45 trillion, about double the U.S. Their debt to GDP is running about 300%. It's almost triple the U.S. Yet their latest PPI measure is minus 3.6%, and their 10-year note yields are running 1.77. This is a clearly severe deflationary economy that's being propped up by massive fiscal and monetary stimulus. And if it continues, and they're exporting a lot of the deflation to the rest of the world, i.e., because the U.S. is cutting them off, so they're exporting as much as they can. If that trickles down, which I'm afraid it will, with the U.S. stock market just dropping a little, that's a normal deflationary cycle that in history has almost always followed inflation. And there's a book written by Edward Chancellor that points out it's the price of time that shows those are always the cycles. There's plenty of other books. Another one's called Boom and Bust by Quinn. But that's what I'm worried about. We'll see how we end up by the end of the year. That's why I'm looking forward to our next conversation. But right now, I'm really concerned that copper will go down with the U.S. stock market and tilt us towards a deflationary environment.
So when you say a little, because little is a relative term, how much of a slide back would trigger these concerns?
It's just going back to 4. That's the problem. Copper has had a great couple of years of trading. It started at 4, it popped up to about 440, went back down to 4, and then right back up to 496 was actually a high tick. And some people trade it, know that well. I don't anymore. I just watch it. Thank God I don't trade anymore. I used to be able to do that. And now it's back down to near 4. That's my point. If it starts trickling towards 4 to me is a line in the sand. Standing below 4, which is unchanged in the year, and it's been key support forever. All the trend lines are pointing up. It's all bullish. You know what that means is when everything's bullish and all the technicals, analysts are bullish, it has to go up. And to me, that's the risk. And what we did this year by running those stops, heading right back down to 4, to me, the risks are we're going to continue lower. It needs to recover, basically. So I also put it in the same bucket as Bitcoin. Bitcoin's the same way. Everything's tickling higher. Looks like it's going up, yet it's starting to show some weakness. So this is where we're speaking on August 26th. It's, we're getting towards the volatile time of year. And those are the key levels. So here's the way I like to put it. I see the key support for copper is around 4. The key resistance for gold is around 3,500. I think by the end of the year, gold's more likely to go above that level, and copper is going more likely to go below that level. And the key force for that to happen is if the U.S. stock market just starts ticking down maybe 5-10% from where we are now. Now, if it ends up down in the year, that's a severe problem. And that's my point. We're at such elevated levels now in U.S. equity valuations, versus the rest of the world. It was the highest ever just a few months ago, at the beginning of the year, versus GDP. Still about the highest in 100 years. These are levels that are unsustainable over time unless it's different this time.
So is it the tariffs that are likely to be the headwinds that take the market down? I'm looking at it going, they can do one of two things. They can either create inflation, or corporations or businesses simply unable to pass the tariffs through, and they're the ones that have to eat it, and it destroys margins. Neither of these things are good.
You got it. It's all the above to some extent. The bottom line is, let's put it this way. This is the first year of Trump administration's second term. For us to get in, and we've seen the most significant shifts from one human being running this country in my lifetime. Now I'm only 60, so maybe since a war created things. And to get through this period with only that minor, we had basically a 20% correction in the U.S. S&P 500. It reversed on a dime. It went straight back up like the highest recovery, quickest recovery ever. To get through this period without some major discombobulation, I think to look back at that from the future would be very unlikely. So I think it's more likely we're going to see what you said, the tariffs pushing back in the Fed, pushing back on data from U.S. economic data, all those kind of things that kind of made the U.S. great, and made U.S. stock market valuations really high, i.e., low tariffs, where U.S. companies were able to offshore cheap stuff, is going to be a major tax on profits. I think it's going to be a bit of a problem. Also, we already many signs tilting that we're tilting towards a potential recession in terms of, just look at auto loan delinquencies, credit card delinquencies, the housing market, things like that. No, so far, everything's being held up by the greatest wealth effect in 100 years from the stock market and housing. And that's why it has to be sustained. And to me, the risks are that it won't be. We've reached a bit of an end game. So, but that's why, what's my key signal for it? Gold. Gold's beating everything this year. And certainly since Bitcoin reached 100,000, gold's just taken off. So gold to me is a signal that you should be very careful with risk assets and that we're due for a little bit of normalization of the valuation of U.S. stock market.
Yeah, gold touched a high of 3,500 back a couple months ago. It seems to have resistance there. Does gold go higher from here?
So firstly, let's talk about what's driven gold up. And it's a perfect chart pattern, like I mentioned, a 5-month bull flag. It's built a base around 3,300 since April. So sustaining below 3,300 may be a problem. Sometimes you have to hit stops and then you go back up. But central banks are still accumulating. And one of the most significant things that changed this year, Michael, was despite the U.S. stock market on a tear, gold ETF holdings or investors have shifted substantially to buyers and inflows. 4 years in a row since 2020, we've had outflows in gold ETFs. Now, this year, they're up 10%, up to almost 92.5 million ounces. The low was around 80 or so. And the high in 2020 was 110 million ounces. So significant shift in ETF investors are buying. And this is despite the fact, one thing that almost always happens is you see ETF investors in gold buy when volatility is going up in the stock market. But volatility has been, this is a 50-day average. The VIX is collapsing. We just reached a low. So investors are starting to shift over. I think they're sensing a bit of an end game for the U.S. stock market wealth creation machine. And one thing to remember about gold market absolutely loves President Trump. Every time he comes out lately, like he's going to fire another Fed governor, or he's going to try to fire Chairman Powell, and he fires the person who disseminates the data for the BLS, even though they're just doing their job, and pushing back on a lot of the rule of law, and certainly the tariffs. Gold loves the volatility of this human being, and I don't think that's going to change. So I think it's just a matter of time it gets above 3,500 an ounce. But I'm very fearful that it's going to get to 4,000. And I think an easy way for them to do that, which is what gets gold to 4,000, if the stock market ends up maybe unched on the year. That's like a 10% drop, but that's unched on the year. Gold's just waiting for an excuse to break out, and it needs a good reason to not go higher. Like I said, central banks are still buying. ETF are in. Sure, there's a little speculation. Always there is, but there always is. But for 5 months now, the same price, it's just the market ready to break out higher. I just need a good reason for it not to. The number one reason for it not to go higher would be if the people just say, "Oh, forget the U.S. stock market just going up forever." I'll go back to that.
Yeah, well, it's at some point it has to stop. Things don't go up forever. Things don't go down forever. Gravity, what goes up has to come back down again. So, the other interesting thing that's occurred, this year is there's been a lot of price discrepancy in the commodities that we've spoken of, where the COMEX has been one price, but if you deliver to New York or to London, to other places, it's a different price, and oftentimes a much higher price than they could have delivered in the COMEX. Are we starting to see this as a bifurcation of commodities markets, so that local supply and demands, like things right now are still okay in the US? They're in deflation in China, so I got to think copper's cheaper than China than it is in New York, as an example. Are we starting to see that kind of bifurcation in commodity prices starting to happen? If we is it local economies, or are we going to start to see an East versus West kind of pricing that's going to occur?
I think we could see that. But let's start with copper. What happened with copper where that spread reached a 30% premium on the COMEX versus the LME, obviously US copper versus London copper and versus copper anyplace else? That's earmarks. When you do that kind of make those kind of moves, you typically those kind of highs can last for decades. Um, when you make those kind of extremes, one example is crude oil at 147 in 2008. We've never seen that price again. So copper's price high this year, 596. I'm really worried that could make a high for a long time. Part of what caused it just caused a lot of pain. It was on a major paradigm shift. It's all indicative of the significance of the tariffs, which turned out to be on refined copper not so important. But when you do those kind of moves, you just flush people out. You just cause a lot of pain. So I'm concerned about that indication there. And what, like I say, I'm putting it on the shorter term. If it ends up weaker on the year, that's a signal this might be decades before we ever get above that price level. So copper's a key one. As far as how long that stuff's going to last, I think it's still we're still early days in the Trump administration. They also are learning the risks of creating too much volatility in markets, which is bad for everything. The key thing that we remember is the Trump administration has been completely emboldened to instill and institute significant tariffs on the rest of the world by one key factor, the U.S. stock market. So remember on April 9th, when Trump announced the 90-day reprieve of tariffs, that happened for one reason, because the stock market dropped about 20%. Now it's up 10%. And there's only one key force, I think, that's going to push back on what's been causing a lot of these discombobulations in markets. In commodity markets is our Trump administration is emboldened by stocks. And I'm afraid that's the case, and they should be. But Trump is also at risk of what happened with Herbert Hoover. Just poor timing. He just got elected when we're already about the most elevated stock market in history based on those GDP, stock market of GDP and versus the rest of the world. So commodity discombobulation, I mean, not so much. I mean, I look at crude oil as pretty much normal with the U.S. and Brent and WTI. It's only copper was the big one, and some of the other metals I just don't watch as closely. But also indicative of where things are going. Just look at iron ore. The price of iron ore about $95 a ton in China has been declining for a while, along with bond yields. That's an indication of what's happening with industrial metals. And I don't overall. I look at the macro. I don't see the upside unless we get lucky. But I do see heavy risks if we just see a little bit of, just a little back and fill in the U.S. stock market, which is normal. And people might say it's a crash, but when things get this expensive, mean reversion, just a matter of time.
Yeah, that's another term that's kind of lost all meaning is the term crash, because what people consider to be a crash today is nowhere near as reality of what a crash actually looks like. I think the last real crash we had was in 2008.
Well, the biggest crash this year was copper, realistically, from the highs. When you drop literally 20% in a few hours, and in one of the most liquid futures markets on the planet, I mean, it's up there with crude oil and gold. That's a crash. Now, it's still up in the year. Just like I like to say, the 1987 crash, stock market crash in the U.S., we still ended up in the year in the stock market. But that was a crash from the highs. It's just now what's the aftermath from it? So I'm worried about the implications of what the market means when it crashes like that. And I don't think it goes and just retraces it and goes right back up. If it does, it has to at least start by spending some time above 460 in copper. I'm more afraid it's going to continue to head towards 4.
Yeah, well, as you say, we're heading into the volatile season. We've had high prices, and as we prefaced this conversation, high prices can be the cure for high prices. So we're going to have lots to talk about as we go into the fall and then head into the end of the year, Mike. If people want to follow your work, Mike, how would they do so?
Well, on your program, thank you for that. Prospect News, I appreciate that. I'm on the Bloomberg Terminal, and X at Mike McGlone 11, and LinkedIn, Mike McGlone Senior Commodity Strategist with Bloomberg Intelligence. And I'm happy to add people to my distribution list. They just reach out, and I appreciate you having me on, Michael.
Well, I appreciate you taking the time to go through these markets and provide a little bit of clarity when, quite frankly, the winds seem to be blowing from multiple directions all at the same time.
Yes, our next call should be interesting. I'm hopeful that things will be fine and the fall volatility will not be about markets falling too much, but I'm fearful that we're going to get some overdue normalization of risk assets.
Yeah, well, we'll see. The next Fed is towards the end of September, and leading up, as if they do something unexpected or Trump fires everybody, because that's a possibility apparently. We'll have to see what the
But
volatility does.
it's very profound to say that. So let's look at the future here now. If you're a data provider, you work at one of the data agencies, and you see some of the data coming in that's unfavorable to the Trump administration, you might be less inclined to be reporting it and doing it, probably partly because having had 5 dependents and raised a lot of kids, and you need your job, you might be careful about that. And also, let's look at you put more people on the Fed. You're not going to, it's going to become a third world country like Fed, a third world country like Fed, where they're just going to do what the president wants, which is going to really be bad for what's really great. A lot of countries like us in Canada and people with independent fence, great is that independence of, not just doing what the politicians want, where you get runaway inflation and risk assets only go up because inflation rather than organic humans making money from making things better. So I'm really concerned about the implications of just what this president is. And there's going to be a future of a Trump detox. But right now, it depends on where we start heading. If we start heading to the next few months where stock market goes down anyhow, the Fed's going to have to ease. But if they're easing because of political pressure, that's back to the old days. And that means that U.S. premium of risk assets should be evaporating.
Yeah, well, it's you got two guys holding the punch bowl. One wants to toss a turd in, the other one wants to take the punch bowl away. So we'll have to see who wins. So you're right. There'll be plenty for us to talk about in the fall, Mike. You take care, and
Yes.
thanks for your time.
Thank you, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.